Good morning, everyone, and welcome to the latest in our series of Skybound Capital webinars. Happy Tuesday, and a very warm welcome to our Skybound Capital team all around the world, from our offices in London, Hong Kong, Mauritius, most specifically this morning to our team in Australia, who are going to form the integral part of this webinar, and also to our chairman, Cliff Warren, who is present on the panel, along with our head of human resources, Kate Mapham. So today, we thought it would be a useful opportunity to give you some insight into Skybound Capital's operations in Australia, and give you a background to the business, how it came about, and the various sectors and industries in which Skybound is active in the Australian market, and then also some insights from the team on the ground there around how Australia as a country has been handling the crisis in which we find ourselves, the support from government for the commercial sector in Australia, and how that helps them to position for coming out of the COVID-19 pandemic. So we are joined by the CEO of Skybound Australia, Jeremy Thorpe, also Dean Palmer from Skybound Fidelis, Paul Walsh from Sky Credit, Steve Chant from the Leisure Group, and then also Henry Jones from Entertainment Group. So I'm going to start with Jeremy as the CEO, the obvious place to start, and to talk about the beginning, the evolution of Skybound Capital in Australia to date. Jeremy, a warm welcome to you from the Gold Coast.
Thank you, Matt, and a very warm welcome to all our listeners around the globe and in Australia. And yes, we started the Skybound journey after a visit to the country by Cliff in 2014, where he met with many credit providers and regulators to get a deeper understanding of the credit environment in the country. And this was on the back of the huge success of the Prism Income Fund globally. So his visit proved very opportune in that post the 2008 global financial crisis, the Australian federal government responded by introducing stringent new responsible lending obligations on credit providers by way of the National Consumer Credit Protection Act. And this resulted in a deep regulatory change to the credit landscape with enforcement undertaken by ASIC. It covered all consumer credit products and all intermediaries providing advice on such products, including through electronic or other arm's length means. And it also included a national licensing system for finance brokers and a licensing regime for credit providers, giving consumers a guaranteed access to approved dispute resolution services. Importantly, what also happened simultaneously with this change in the regulatory regime was a major technology pivot, and no longer did borrowers need to visit bricks and mortar outlets, banks, or other ADIs when they required loan applications, assessments, and approvals, but this could now be done online. And over succeeding years since Cliff's visit, this has created a number of consolidation opportunities, as many companies have struggled to pivot from bricks and mortar to online lenders. But it also presented us with a big opportunity for SME lending, and it also resulted in some of the banks and other ADIs tightening their credit regimes. All of that fell exactly within the scope of Skybound Capital's credit orbit. So his visit couldn't have come at a better time. What also became very evident was that technology, data, and credit scoring were going to become a major theme in the credit environment. So with the pivot to online, both in Australia and on a global basis, the data universe has become paramount, and this abundant new resource has really revolutionized global consumer credit and enhanced the whole credit scoring process in numerous ways. For instance, instead of looking at a snapshot of a credit score, it's now possible to analyze the direction, velocity, tipping points, and magnitude of changes in a consumer credit history to get a better, more accurate picture. And this is called trended data and can offer up to a 20% improvement in predictive performance. Obviously, a very important feature of credit risk for the group. And credit history, whilst it's important, there are numerous other sources of data which can provide a view of a consumer's creditworthiness, including data taps into information on property ownership, wealth, how a consumer pays everyday bills, and other data sources which provide a more rounded picture. So technology is hugely important in today's environment. And lenders now have unprecedented access to credit data. And in the meantime, there's some new advances being made where neural networks are being implemented to give even more sophisticated credit scoring capabilities. Skybound, I can tell you, is at the forefront of all these developing initiatives in Australia. But importantly, this environment gave Skybound the comfort of knowing that they would be operating in a regulatory environment which was very compliant and with strict enforcement and a strong technology overlay, and also numerous opportunities for private capital at the same time. So in short, what happened after Cliff's visit was Skybound made 2 exploratory and very successful funding arrangements directly from offshore into Australia in 2014, 2015. And that really started the ball rolling here. But it soon became apparent that a permanent presence and a full Australian financial services license would be required if the company were to optimize on these credit and private capital opportunities in Australia and gain any significant traction. So that resulted in the board taking a strategic decision in 2017, which led to the successful acquisition of Fidelis Investment Limited, a boutique fund management company which was managing several retail and wholesale property funds, and which importantly had a full Australian financial services license. In 2018, shortly after the acquisition of Skybound Fidelis, we made a small amendment application to ASIC to include credit in our license, and this was granted. So we were able to add credit to our suite of products. And we established the Skybound Fidelis Credit Fund soon thereafter, and that fund in many ways mirrors the global Prism Income Fund. A further strategic board decision was made in 2019 to acquire Fairgo Finance, an established and highly credited Australian credit license holder. And with that acquisition, it further broadened our suite of products, our technology and credit assessment capabilities, and it's enabled the group to undertake B2C lending as well as B2B lending, offering further diversification and participation in a broader credit marketplace. Whilst all of this was happening, the emergence of data as a key component of the online environment and technology emerged. And strategically, it became clear that there was an insatiable demand for credit in many sectors, such as the holiday and leisure market, the cruise industry, and the entertainment sector, where a new form of credit was emerging. The buy now, pay later, or BNPL model was emerging as is emerging as a disruptive, and the significance of data has become even more critical and valuable. So across all of our business sectors here, we've evidenced a steady increase in the cost of digital marketing. And the acquisition of accredited databases has become essential to sustain growth and repeat business, and resulted in us taking some opportunistic exposure to the travel and leisure sector, whilst investigating the introduction of credit products to support the holiday and leisure industry, which is a major contributor to Australia's domestic and international economy. And this strategy resulted in the acquisition of several lifestyle brands with high growth opportunities domestically and globally, all of which have got extraordinarily strong technology overlays. So taking all of that together, we've successfully, over the past 5 years, assembled a team of highly qualified and accredited chief executive officers, all deep industry experience and all experts in their fields, each one of whom has played a significant part in helping us achieve our strategic goals in Australia. And from the time that Cliff first visited the country until now, we've grown our assets under management from zero to a little over 150 million, whilst maintaining a core Skybound investment strategy, which is geographic and sector diversification. So we're left with a core portfolio focused on real estate and credit, with about 76% of the portfolio exposed to credit and real estate, and approximately 24% exposed to the travel and leisure industry. So Matt, in a nutshell, that is our position on the growth of the group in Australia. It's been a very interesting journey, a very exciting journey. We started off fairly slowly on an exploratory basis, but we gained momentum as we gained confidence and knowledge in the industry. It was also very clear to us that to be successful in another country, we needed a lot of local expertise. So I'm pleased to say that we've got a team of great CEOs, very supportive, all of whom have bought into the Skybound Capital ethos. They've all visited Skybound Capital, with the exception of Henry, who recently joined, but I'm sure he'll meet the rest of the team in due course. And we've got some incredibly exciting opportunities facing us, despite the recent challenges that have come about because of COVID-19. And I'm very pleased to say that we're expecting some real growth to continue over the next or the forthcoming decades. And I've got a small graph here which I can share with you, just to give everyone a bit of a snapshot of assets under management and the sector breakdown. So from this, you can see that we've got about 26% exposure to travel and leisure, 39% in consumer credit, 30% in commercial property, and 5% in development credit. All of that credit is with counterparties that we have deep inside relationships with, which is very much part of our ethos as a group, and we keep in regular contact with everybody. I've also got a graph here showing the growth of AUM from inception. So you can see in the early days, whilst we were still exploring the landscape here, our growth was fairly modest and flat. And then with the acquisition of our financial services license, things started picking up, followed by the credit license, and then the last sector is just part year only, but a very creditable growth history, and one we think is sustainable. So that's the introduction from me, unless there are any questions, which we can pick up any stage you like. So
thank you, Jeremy. I think it's very difficult to try and encapsulate in 10 or 12 minutes this journey that you've been on. But I think what's fascinating is what you've highlighted in that graph actually is that, you know, slow and steady at first, and then various milestones along the way that gave you the opportunity and the capacity to grow into different sectors and to expand your operations. And I think it makes most sense now to introduce Dean Palmer. from Skybound Fidelis, because you referred to that being such a key point on the journey, the acquisition of a financial services license in Australia. And that made sense to do it along with Dean at Fidelis. And Dean, perhaps by way of introduction, I can ask you about the license that Fidelis held at the time, and then why the partnership with Skybound Capital not only made sense to them, but to you as well.
Yes, Skybound Fidelis was established in 2011 and has continually operated a Australian Financial Services Licence, or AFSL, over the past 9 years. An AFSL is critical to operating a successful and scalable funds management business in Australia. Over the years, Skybound Fidelis has developed a very broad, compliant AFSL and with a strong track record. Our AFSL enables us to accept investments from all investor types, ranging from the wholesale or professional investors right through to retail mums and dads investors. We also have a very broad licence in terms of product coverage. We are able to launch products to the market covering all forms of property, all forms of credit, and all forms of securities as well. I was actually introduced to Jeremy and Skybound back in 2017. And what became apparent very quickly from those discussions was how a partnership with Skybound would have two main advantages. The first was access to more investment capital from across the globe, which would enable us to increase our assets under management. And the second was access to skills and expertise to launch new and exciting products. So up until, as Jeremy mentioned, up until the partnership with Skybound, our product suite was solely focused on commercial property investment. So both of these advantages have been proven over the last 2.5 years, with our assets under management growing almost 5 times over that period. And we've also successfully launched 2 new products in the credit and securities sectors.
Dean, perhaps you could provide us with an overview of your investment approach to commercial property, because you bring a novel approach to it, and one which a client finds very simple to understand and to interpret.
Yeah, look, as mentioned earlier by Jeremy, approximately 30% of our assets under management within the Skybound Australia portfolio are invested in commercial property. Just some broad overview of the commercial property sector in Australia. It's valued at about $0.7 trillion and around about $40 billion in transactions occur each year. There's broadly 3 main categories of commercial property. There's retail property, which is examples, large shopping centres and malls. The second category is industrial, classic example being your large logistics warehouses. And the third category is office, once again, your classic example being office buildings in your central business district. There are also a range of activities that you can undertake within the commercial property sector, ranging from construction, development, through to refurbishment of existing buildings, and also repositioning assets for future growth. Our focus in Skybound Fidelis is very much in the lower risk section of that sector. Our key focus is to look for properties that meet a stringent set of criteria. So we focus on things like only acquiring existing properties. We don't do development or construction. We focus on specific locations that we know well within Queensland, and particularly Southeast Queensland. We look for properties with strong tenants who have a proven long-term track record, and we will only acquire properties with long lease terms. And an example of that is we have a number of properties in our portfolio that have 10-year lease terms. And importantly, the properties must also yield income returns to our investors of 8% or more and must have the potential for capital growth. I'll just quickly share my screen with you just to show 2 examples of properties that we currently have in our portfolio. So the first one there is a property we bought back in December 2016 for $8.265 million. It's a large industrial asset with over 15,000 square metres of land and 6,000 square metres of building lettable area. It's a 10-year lease term to an engineering company with a 20-plus year track record here in Brisbane. And as you can see, we've had 27% growth in the capital value of that property over the last 3 years, and we've been paying 10% cash distributions to unit holders as well. And you'll see the similarity with the second property that I've got there in the slide. Once again, an industrial asset, 12,000 square metres of land, almost 8,000 in net lettable area. Purchased only about 6 months ago in October 2019, so we haven't had that asset revalued yet. But from day one, you'll see we've been returning 9.5% cash distributions back to our investors. And once again, a 10-year lease to ABC Manufacturing, which is a specialist in kitchen cabinetry and part of a much larger group with, once again, a 20-year plus track record. So I think those two examples give you a very good perspective on what we do in commercial property in Australia. Back to you, Matt.
And Dean, commercial property, like any other sector, it would be naive to think that there's been no effect by the current COVID crisis. And if you could share with us some of the actions that you've had to take in the business and how you are positioned to emerge from where we're at right now.
Yeah, absolutely, Matt. Look, the most direct impact of COVID-19 on the commercial property sector is actually the impact on our tenants. To the extent that a tenant has experienced a significant fall in their revenue, that means that their ability to pay their rent to us is also potentially adversely impacted. The Australian government's actually stepped into this space and they've mandated a set of protocols to protect tenants during this period. In broad terms, landlords are required to provide rent relief in certain scenarios where a tenant's revenue has been severely impacted by COVID-19. But the interesting thing, Matt, is that as part of that process of having to provide rent relief, it's actually provided a good opportunity. We've been able to have some proactive dialogue with our tenants, and that's given us the opportunity to actually reposition some of the leases. So I can actually give you a live example of a conversation that's happening at the moment. We've got a particular tenant, which is a gym and part of a massive group across Australia and New Zealand. And they've requested from us a 4-month rent-free period because their revenues have actually dropped to zero as a result of COVID-19. They've been shut down. But as part of those discussions, we've been able to negotiate a 24-month extension to the term of the lease, which not only increases the capital value of that property, but also underpins the revenue stream going forward. So that's been a real positive. The other thing, very briefly, is that we also see probably a depressed market coming out of the back of COVID-19 and less buyers in the market. So we've already got our feelers out there, and we think there'll be some really good opportunities to buy some new assets in an environment with less competition over the next sort of 3 to 9 months.
And presumably your strategy of dealing with a property within its own fund structure gives you that flexibility and the ability to be nimble and to respond in a quicker fashion.
Yeah, absolutely, Matt. All of our properties sit in their own special purpose vehicle, which means we can make decisions for those properties specific to that property and specific to that group of investors. So yes, it does provide that flexibility, and it also does provide a degree of asset protection for the investors, so that if there is some sort of major problem in the portfolio, it's ring-fenced and protected from the rest of the investors.
Thank you, Dean. So a significant portion of the portfolio in that commercial property section. Jeremy also mentioned that consumer finance was a natural place for Skybound Capital Australia to start, given Skybound's knowledge of the sector in other territories, and it's remained a key part of the portfolio and led to the growth of Sky Credit under the guidance of Paul Walsh. Paul, great to welcome you to this Skybound Capital webinar. Perhaps you could give us an overview of the industry as a whole in Australia and how it became such a key industry, the highly regulated nature of it, and how your business is positioned.
Yeah, thank you very much, Matthew, and welcome to everybody from Perth. So I've prepared a presentation for today, so I'll walk through that, and I think that'll answer some of those questions you've asked. So we'll touch on a bit of the company overview, the credit regime in Australia, the acquisition which was got us to the scale that was what Skybound are looking for, touch on the current environment, which is a topical to everybody, and then talk about some of the strategic direction we're going in. So I founded the company in 2008 following ownership of a previous business in the same industry. And since then, there's been a mix of capital raisings over time. So family and friends equity raising. And it was around that time that I met Jeremy through our industry association, where both of us were on the board of that industry association. And with the introduction of the National Consumer Credit Protection Act, that was a very dynamic period in the industry. So I got to know Jeremy very well, and when the opportunity came to invite him on the board, it was great to have him join the company. 2016, MyBucks, who are a South African-based company based in Pretoria, were looking to expand, and they acquired the minority interests in the business. And so MyBucks acquired the minority interests who had previously supported the growth of the business. We then together undertook an acquisition of Capfin, which again, I think we had established a long-term relationship with Skybound. I suppose we've been courting each other for some time. And then in 2019 came together as a joint venture with Skybound taking a major interest in what is now Sky Credit. So the consumer credit regime in Australia was largely unregulated prior to 2013 and led to some very poor outcomes for consumers. That regulation, which came into effect in 2013 through the introduction of credit licenses and governance by ASIC and under the National Consumer Credit Protection Act, it provides a very good framework for lenders to grow, and it reduced a lot of the regulatory risk and associated with the industry, and harmonised a lot of the laws which were previously a state-based, cottage-based type industry. We saw a maturing of the industry and also a really rapid rate of growth in competition in the industry, which led to a flood of credit being available to consumers. Since then, we've seen a continual innovation in the sector, and Jeremy referred to earlier the advance of the buy now, pay later sector, which is very much around a very good outcome or very good user experience when buying items online or just undertaking their normal daily activities online. So for us, that's a way that an area we are focused on delivering and meeting customer expectation and whilst balancing the requirements of consumer credit protection and really and compliance. And I think being able to balance both of those does provide businesses a competitive advantage and a path to growth. So with the in that environment, with the growth of competition, we had Capfin had been purchased by Pepkor SEA in 2015. So again, similar, another South African entity looking to expand globally, having had a retail footprint in Australia. That growth was short-lived with some of the issues that came out of the Steinhoff accounting irregularities in 2017, but created an opportunity for us to scale and acquire that business in 2018. So what they did was took two largely subscale businesses, so Fairgo and Capfin, who are competing in an online credit market to a very similar target market, and in that from that transaction, it led to a very good financial outcome for Fairgo Finance in that we really realised a number of close to $4 million of synergies between the two businesses, which led to a doubling of the size of the book, a doubling of revenue, and really an accumulation of some capital onto the loan book, onto our balance sheet, which we've subsequently utilised to grow and reinvest into the Fairgo business. So that journey in itself was pivotal to us acquiring more data that Jeremy has been talking about earlier, and growing the scale of the book and being a far more relevant player in the sector we're in Australia. Now, the Iron Man picture there is quite novel, but really it shows that customer expectation these days is a real balance between part man and part machine, and it's something we refer to internally about trying to get that balance right. But really, that's where customers are expecting us to be, is quite close to the machine in their experience. In terms of the current environment we're working in, and clearly it's had an impact on all of us, but where we've been able to move quite quickly, we've been able to adjust quite quickly as well to the environment. So really our switch as a business went to defending those recent gains from the Capfin acquisition, and supporting our customers as they go through this time of change as well. We very quickly forget the impact on people, and I think we've been able to very well customise a response to this that is personable to our customer base, and provided great support through that process, either through restructuring their existing arrangements or putting payments on hold and providing hardship relief for those, all of which are part of that framework which is required by ASIC and compliant lenders in Australia. So since the start of April, we've really seen the environment stabilise a bit, and that really does follow the government relief that came into effect. But suffice to say, application volumes currently are down 40% from the pre-COVID levels that they were, and our loan book arrears have increased by 26%. Both of those have stabilised significantly in the last 2 weeks, and we've been able to really restructure that. So really, of that loan book arrears, 2/3 of the growth in that has been just purely restructuring payments, and 1/3 has been providing arrears or payment holidays for customers, and that equates to probably or roughly around 7% of our total loan book has been affected by the COVID impacts, whether it's directly people losing jobs or their financial circumstances changing. So since that's taken place, we've moved pretty quickly to adjust our pricing. We have a risk-based pricing approach in Australia, or as a business we do, operating in a number of credit markets. So for the environment, we have increased our prices. Our credit policy changes have changed in terms of restricting access to people who may be in industries that are adversely affected, while at the same time being able to confidently advance credit into industries that are positively affected. So, healthcare, medicals, those kind of sectors. And at the same time, we're also bringing new products to market, which provide more flexibility to customers. Additionally, it has provided some time for us as a business to prepare and position for when markets open up again. So we are accelerating some of the development of whether it be the new products or new systems and offerings to customers. It does provide some downtime to really refine those offerings before we have them ready for markets in the next 3 months. So our strategic direction is now really one of growth, and whilst this has been somewhat impacted by the short-term COVID impacts and priorities to really defend that the current revenue base. Really, the next phase for us is really about organic growth for direct customers. So really accelerating that Fairgo brand in the market, and primarily through improving our, but also entering new credit market segments where we have a strength or a competitive advantage, and some of those are through partnerships and others are through capabilities. And Jeremy has spoken about data analytics, credit risk scoring, through some recent recruiting out of people that have emigrated to Australia with deep skills in this area that who bring a great capability to the business. We've been able to really enhance that area within our business and work with local credit bureaus and build on our adoption of comprehensive credit reporting in Australia to refine our credit risk framework, and we look forward to launching that in the next 2 months. So that's quite an exciting phase of growth for the business, and will unlock a lot of opportunity in the future as we do improve our operational efficiencies. So suffice to say, whilst we've got a short-term focus on defending the revenue and our current customer base and supporting them, we still have an eye on great market opportunities in Australia, and we look forward to further support from Skybound to deploy capital and to grow in our market share in Australia.
Just by way of summary as well, something that Jeremy touched on in his introduction is to just reinforce the the regulated nature of the space in which you operate. So you talk about being nimble and flexible and being able to change and go into new markets, but it all does have to be done within a very, very specific regulatory framework.
Yes, absolutely. In 2013, the ASIC provided licenses to people. They then went through a couple of year period where lenders used their license, and then they went through a period of auditing how well they used their licenses, and have really come down heavily on the industry across all sectors, whether it be B&W Finance, whether it be Westpac, whether it be auditing ourselves. Really the regulator has stamped a clear expectation in the market and communicated that it's not called the National Consumer Credit Protection Act for nothing. It's really about how you protect consumers and while you provide them credit. So, licensing, dispute resolutions, documentation, responsible lending, data retention, offering credit. So, from that perspective, it has seen a reduction in participants really as companies have grappled to meet both the balance between a commercial opportunity and that regulatory and licensing expectation. And I think I think we seem to be getting that balance right. And I think that's really has opened up some opportunities with other businesses who are wanting to work with a brand that is also seen as a responsible lender.
Well, thank you very much for that, Paul. I'm now going to cross to Steve Chant from the Leisure Group. And Steve, we've heard from all the presenters so far in the Australian business about the assistance and the response from government in Australia to the crisis that we're in being particularly good and some phenomenal support. And I think perhaps more than anyone, you've experienced this in your business. And travel and leisure are the core of your business. Now, we all know, we can see worldwide the impact that has been had by the situation we are currently in. But what I'd like to ask you to do is just position your portfolio prior to this, because it'll also give people a clear understanding of how popular the space is in the Australian market, and then also how you've been able to respond to the circumstances we find ourselves in with the support of government.
Thank you, Matt, and hello everybody, and a very warm welcome from the Gold Coast. Well, firstly, Skybound's interest in travel and leisure began when it acquired its first Australian business that was a marketer of hotels and resorts worldwide. This business quickly became an industry leader in promoting travel and leisure in Queensland, initially through its call centres and then ultimately online. Since then, the business has built both organically and through acquisition, and I might just share my screen at this stage. So it's built its business both organically and through acquisition, and it's built an impressive database of customers totaling more than 300,000. What's even more enviable is, in fact, its social media following, and it has more than 500,000 engaged customers. It's also resisted pressure to relocate its call centres offshore, which many of the larger travel-related businesses have done. And this strategy has proved to be absolutely invaluable now that we're dealing with the COVID-19 pandemic. Now, why we like the industry is because of the size of the market and its growth prospects. Because of its size, it gets extremely positive government attention. The sector is serviced by something like 300,000 rooms. The sector confidence is still very good, still very high. There's some 57,000 planned rooms to be built over the next 8 years, 1/3 of which are already under construction. The sector employs over 660,000 people nationally and sells more than 74 million room nights per annum. Our business in leisure has a strong focus in Queensland, and Queensland features 4 of the top 10 most visited cities in Australia: Brisbane, Gold Coast, which is the beach travel mecca of Australia, the tropical north, which is highly dependent on international visitors, and then the Sunshine Coast, which is reliant primarily on interstate visitors. Matt, to answer your question, why we like the cruise industry is really it complements our existing business. Accommodation pre and post cruises is paramount. We can resell across all of our databases. It is a natural product extension to what we're currently selling through our call centres, and it's experiencing high growth through demand. We're predicting growth of more than 20% year on year for the next several years. We've invested in a business that was pioneered by an individual more than 20 years ago for selling of cruises online. This person had deep industry knowledge and extensive supplier relationships. That was the key rationale for us to acquire that business. And the product spread meant that we're not reliant on what is often the case in the cruise market, and that's the discount warfare. We believe that home port cruising, which is domestic cruising, is less than 1/3 by value of all cruising done by Australians. So this market is massive for all of us. Because Australia is so geographically spread, we rely heavily on air travel for domestic holidays. Last year, we had some 26 million international inbound customers through or international seats. 77 million were domestic. Of those 26.8 million inbounds, 9.6 million were arrivals by international visitors, and they stay on average 32 nights. Most come in for a holiday, which is about 4.3 million, about 700,000 for business and 600,000 for education. All of these have been impacted by COVID-19. So the airlines are inextricably linked to travel and leisure in Australia. So as a country, we do love to holiday. We welcome international travellers. It's good for the economy. But that was the situation in January of this year. So if we dial forward 1 month to COVID-19 and the world of social distancing, we can see by this graph, inbound traffic has reduced significantly for the month of February, down 26%. For the month of March, the results have not been published yet, but we're expecting a huge drop-off. Perhaps the most defining moment in the industry was when Qantas cancelled 60% of its domestic and international routes and then stood down 2/3 of its staff. That followed by the closure of restaurants and then lockdowns, travel restrictions, border closures, international travel bans, and then to top it off, cruise ships were ordered to leave Australian waters. The graph that you're seeing now is a recent survey conducted by the federal government. As you can see, the accommodation food sector, which is where we operate predominantly, has been affected by more than 90% reduction in its business. What I can tell you is that the cruise industry has had close to 100% reduction, and followed closely by education and training, arts and recreation, and of course the retail trade. So we're all impacted by those sectors. So what does the future hold? And probably most importantly, how do we get there? We need to preserve cash to be ready to relaunch, and we need to preserve our human capital. So what the next slide represents is what's happened pre and post COVID-19. The blue line is in fact our revenues. Come February was probably the key turning point when the revenues dropped. The orange line is our cost of employment. This demonstrates how quickly the COVID-19 impacted our business and how quickly we were able to respond. But more importantly, is how quickly the federal government was able to respond through its various packages, including the JobKeeper package, which enables us to keep our staff employed gainfully for at least the next 6 months. There were also other cost measures introduced by federal government, including the mandatory code of conduct for landlords to negotiate rent reductions. We've been able to take advantage of that as a business and as an industry. We've been able to defer interest payments with our banks. The state government has offered federal government loans, 10-year loans, interest-free for the first 12 months. Our banks are offering government guaranteed loans and the state governments are offering various tax deferrals as well. So we've been able to take advantage of all of this. In effect, if we need to hibernate the business, we can, but we still need to tick along during this COVID-19 support period. But to get back into the market, during this period, we do need to focus on some key themes. One is technology enhancements. So during this period, we are spending money and we're enhancing our technology, including a payment solution for Travel Now, Pay Later in conjunction with Fairgo Finance. We're re-engineering our business model. We will probably have more work from home opportunities, and we're looking at partnering and expansion opportunities. There will be increased market share during the exit period. There are going to be insolvency issues. We'd like to be able to take up market share as a result of that, and potentially M&A opportunities.
Just one thing I'd love to pick up on there, Steve. You said how Homeport cruising was, in your words, a relatively low percentage. Do you see that as being quite an interesting opportunity to explore coming out of this, given that we know Australians, they like to be out and about, they like to be exploring. Does Homeport cruising present a special opportunity coming out of this?
Yeah, probably the most common question that's asked is when we'll be cruising again. And there are so many dependencies. Once we open the borders and we can travel to those home ports, that Homeport cruising will commence. The international cruising is a long way off. We're expecting that will come back online after 2021. So the Homeport cruising will be the first to kick off, and we're anticipating that within the next 6 months. And what better place to travel through the waters of Queensland? The ships a lot of them had already relocated to Australia at the commencement of COVID-19. We've sent them away, but they will be back. But Homeport cruising will be the first wave of cruising to return to the market.
So something that emerged towards the back end of your presentation as well is technology as well, and at the front end of your presentation, your amazing database of clients, and these are themes that are recurring now across this whole Skybound Australia group. The ability to access large groups of people, the use of technology, the use of social media platforms. And now I'm going to bring in Henry Jones as CEO of Entertainment Publications. Henry, this is an Australian staple. This is a business that has been around for a quarter of a century, but which you are also helping to transition, and which also trades off an incredibly loyal customer base and partner base.
Yeah, that's right. You've done your research, Matt. So thank you very much, Matt. And thank you all to the broader Skybound family, employees, partners, and most importantly, investors. Thank you very much. So as Matt mentioned, this is a staple. It really is. This is a 25-year-old brand with a unique stable of assets. And like my counterparts here, I've got a quick slide giving you an overview of some of the assets that we have. So on the left-hand side there, you see our member base. We've got a large member base in Australia, 400,000 active members, a larger contactable database, very high affluent, mass affluent, nearly double the average income in Australia, with 40% of our members having significantly loyalty with us, having been with us for 6+ years. Those members are through the people whom we get the majority of our revenue at the moment. They buy a yearly membership. Has been a book in the past, which we'll get to in a moment. They then avail themselves of offers from our merchants and partners. This really is the jewel in the crown for us. We have approximately 10,000 contracts across 20,000 individual locations in Australia. And we particularly have a large merchant base in the very high barrier to entry dining segment, particularly the premium dining segment. One of the reasons that we're able to capture that space is not only the history that we have, being around for 25 years, but also the fact that we've got a closed-end user group where these offers are not made publicly available. So premium restaurants don't need to undercut their rates or their premium pricing and perception in the marketplace. We are also a fundraising tool. Our channel to market is through not-for-profits. You'll see over there on the top right. We have relationships with 16,000 not-for-profits, many schools around the country, but also some of the largest fundraisers and charities such as the Anti-Cancer Council and the RSPCA, charities of that nature across Australia. So we sell through them to their donees. Those donees become our members, and 20% of every sale goes back to the not-for-profits. We also have relationships with, or contracts with, 48 corporate clients in Australia, through whom we give a scaled down version of the membership. They don't get the full membership, but the customers of these corporates get a scaled down version of the membership to million users. This triangle that we've got at the bottom, this is really for us the key. We call it the tripartite relationship, and it is a self-reinforcing circle between members, not-for-profits and merchants in small cities in Australia, Launceston, Hobart, Dunedin, Newcastle, etc. We have 20% household penetration rates. I mean, it's incredible. 1 in 5 households, due to this network effect that we get in local communities. In our larger cities, we've got, like Melbourne and Sydney, we've got less than 1%. So that just underscores the amount of potential upside we have in this business, which underpins our strategy of driving a sense of community, both geographic within larger cities like Sydney and Melbourne, but also virtual online, to get this network effect and drive greater penetration, get more members, drive more revenue for our business, make more profit, and also more business to our merchant partners and more fundraising opportunities for our not-for-profits. That's who we are in a nutshell.
And just if you can give us a sense of what you're doing now, Henry, because you mentioned that this has been a publication over the 25-year history, but there is a very current pivot into taking advantage of technological advantages and advancements.
Yeah, so as I mentioned, we have been a book-based business for many, many years. And this is one of the reasons why this company is a great investment opportunity. I have a technology background, and I specifically was looking for a company with strong assets that had not yet made the pivot to tech, and hence there was an upside opportunity. So we have made a decision to shut down the book. This is the last edition of the book. It will expire in June, and we are moving 100% to a digital platform, and we will move from a book-based coupon business to a tech-enabled loyalty platform that drives value between our fundraisers, corporates and members. That's allowed us to do many things. It's allowed us to remove over $10 million of cost out of the business. It's allowed us to remove a lot of complexity that we had in the business. Imagine, I mean, luckily for us, we did make this decision. Imagine being a book-based business in this climate with many, interpersonal services now shut down. At least that we're totally virtual. That it opens up the opportunity for us to take advantage of this time in terms of being a purely virtual fundraising initiative. But it's also allowed us to do different things as well, primarily around improving the customer experience. As you can imagine, with a technology platform, you can deliver our members enhanced search, personalized offers, content that can be updated regularly. Merchants can change restaurant offers, things like that, and also enables us to capture a lot more information, close the feedback loop, and deliver that information in the form of insights back to not only our members, but also our merchants and our corporate partners, that will then ultimately allow us to monetize those assets and those customers in the future as we drive more value to them. So not only are we going to drive more members and more revenue out of the members, we're going to open up more revenue opportunities in those other customer segments that I spoke about. And all of that's enabled by shutting down the book and moving to a tech-enabled platform.
So the other thing that I've experienced, I've been lucky enough to travel to Australia and many different parts of Australia, that you're a fiercely patriotic bunch. Mm-hmm. And it's been fascinating to see the input of federal government. We heard from Steve, mm-hmm. and one gets the sense that transitioning out of this, there's going to be even more support for Australian businesses by Australians. And surely this will also have a very positive impact on your model, is encouraging people to support their local businesses.
Yeah, absolutely. I mean, I have been, frankly, astounded and heartened by the way in which the government has stepped up. As Steve described, it has been a significant impact on the business landscape that we operate within, particularly travel and leisure, resorts, restaurants, hotels, movies, museums, etc. All the partners we serve. The federal government has stepped up. They've given us a lot of support. It's enabled us to keep on all but 2 of our staff members. So we are operating full bottle at the moment. Some people with some reduced days, but it's enabled us to keep, as I say, a full contingent of staff. We're very confident that the restrictions will lift, and at the end of it, the need for our services that we provide for our travel and leisure partners will become even more imperative than they were today. The need for us to drive fundraising opportunity to our charities will become even more important than what they are today. And ironically, when we set our strategy was rooted in the fact that the world context was in a world of rapid change and dislocation, from technology to the way of work to geopolitical events, and hence that drove a need for more human interaction and joyful experiences, and for local communities to get out and connect. Now, ironically, while that may not be possible right at the moment with some of the restrictions, the need for that is going to be even heightened and more enhanced once these restrictions lift. So we think that while some of the details may change in terms of restaurant seating density, etc., our strategy is sound, will be more relevant than ever. And at the end of this, we're really using this time. I said to you that the government funding was allowing us to keep people on. So just like Steve and Paul mentioned, we're using this time to actually get on with some of the fundamental transformations we need to do, primarily around tech, to enable us to come out the back end in a stronger position.
Well, Henry, thank you very much for that update. You too, Paul, Steve, and Dean. Jeremy, I'm going to revert to you to wrap up. This has been fascinating, getting these first-hand insights from the group CEOs. But what comes across very clearly is the synergistic opportunity that exists across the various parts of the portfolio, the large-scale consumer databases, the use of technology and enhanced technology. And these are all synergies which I know you are going to continue to explore.
Absolutely, Matt. Well, thanks for that. And thank you to all my colleagues for their input. I'm sure you found it very interesting. A couple of things. Right from the very beginning, we have always had a strategic view of how the business should grow. And as you probably noticed, we've got very close relationships with all of our CEOs. We share a lot of information. We share a lot of strategic planning together. And what we're really trying to do is optimize all of these assets by taking advantage of whatever's available in their respective portfolios. And as data becomes more important, we're finding that the numerous databases that we've got across the group are extremely valuable. The world is taking a different view of how to value data now. There's some very interesting models emerging with very significant values being placed on this resource. And across the group, we are data rich. And I'm very confident that in the fullness of time, once we hit our straps, because some of these strategies are relatively new, we'll be able to take advantage of all of that. And just generally, I think the Australian government response to COVID-19 has been exemplary. They were very quick to close down the international borders. They had the advantage, of course, of being an island. So once they'd done that, it enabled them to focus on the domestic situation, which they've done in an exemplary fashion. And they managed to flatten the curve relatively quickly. So I expect that most of our businesses will emerge from this COVID crisis domestically a lot sooner than many other countries. There's already a lot of talk here at federal and state level about loosening restrictions. And of course, when that happens, it'll be business as usual for us as a group. And then you heard from the panel that we've been meticulous about taking advantage of every single bit of government support there is available, both for the payroll, for rental relief, for interest rate relief. And I must say that all of our counterparties have been overwhelmingly supportive of us during this time. And especially we should be thanking our staff, because they've also been enormously supportive. And it's not been an easy time for many of them. They've all got families, and everyone's been impacted by the lockdowns and what's been happening globally in one way or another. And our thoughts go out to all of those families who have lost loved ones and family members during this crisis. So, like everybody, we're hoping that this will all come to an end sooner rather than later. But I think you'll see in the global scenario that Australia will be domestically one of the first countries to emerge from the crisis.
Well, Jeremy, yeah, thank you for that. And again, thank you to all the CEOs. Thank you to everybody who's attended from the Skybound offices, our clients, our friends of the company, all over the world. We hope you've found this webinar with the Australian team as fascinating as I have. It's just wonderful to see that the synergy actually strengthening throughout this time and preparing for what lies ahead. So thank you all again very much. I'd like to hand over to our chairman, Cliff Warren, who, let it be said, is missing QF 63 and 64, the Johannesburg-Sydney flight that he loves so much. I know he longs to get back there.
You're right, Matt. I can't wait to get back, but I don't hold my breath to be able to travel anytime soon. But sooner rather than later, as Henry and Paul and Steve has both alluded to, we're taking this time to strengthen our business, the technology, particularly the elements which we're going to pay special attention to. And that's what we're doing. We're using the time productively. I don't think we're going to get back to business as usual until later this year. We're planning on June being back at work. We open up our office in Cape Town in next week. We limited staff, but we're going back to work. And we're taking every opportunity to use this time productively. Kate, I don't know if you want to close off.
Awesome. Well, thank you so much, Cliff, for your words. And a huge thank you to Matt for really bringing together the Australian team in an incredible way. And it's amazing just to see all the different aspects that the Australian team sort of hold. And I think it's just an amazing example of Jeremy and Cliff really bringing the best in the industries and the different industries together, and it just shows what a strong team can do and the growth that you guys have experienced, and we look forward to the next exciting chapter and episode. So thank you so much for all your time and have a lovely rest of your day.